Episode number 6, live from Staking Summit Dubai. And my sixth guest on this show is JP Grubbs from Areta. He's the founding partner of Areta, one of the biggest M&A banks in the crypto industry. Thanks for coming, JP.
Thanks for having me, Yuri.
So my question for you is, why are so many validators eager to sell their business at the moment?
Yeah, it's a good and very timely question. I think in general, we've been seeing an uptick in M&A activity in crypto. So over the last few months, there have been a lot of announcements where either crypto companies acquire smaller businesses in their sector or in adjacent categories to expand their business. Then we've also seen the first wave now of non-crypto companies really entering the game and acquiring crypto businesses, most notably probably Stripe's acquisition of Bridge. And as part of that, staking has always been a very acquisitive category. So already back in 2021, Coinbase and Kraken made their acquisitions in staking. In 2024, we've seen also a first wave of liquid staking, restaking, M&A. And then I think especially over the last 10 months or so, there have been a bunch of M&A deals where, companies from essentially different types of categories in crypto, be it exchanges, mining companies, custodians, data analytics companies, ETF issuers have acquired staking businesses. So first of all, this is more on the demand side. I think there is real interest from companies in different categories that want to bring staking in-house and acquire a staking provider. And then secondly, to your question, that obviously drives some of the supply. People are just, getting interested in entertaining these conversations and selling their validator. But I think also staking has become extremely competitive, especially for the long tail of staking companies. It's been, you will know this best, but it's become increasingly difficult to get into validator sets. Obviously, especially the altcoin market has not performed as well as a lot of people expected. And so it's not necessarily always a very profitable business, especially if you look at the long tail of validators, and it depends a lot on the networks, your client diversification, the networks you support, obviously. But I think that's been driving a lot of activity, and then the market is obviously by definition highly fragmented. So I think in the range of 1 million to 100 million SSR delegation, we're counting more than 300 staking providers across the world. So obviously, there's just a lot of companies out there, and then over time, some might want to explore M&A for some of the reasons I mentioned, because they've been potentially also running a validator for a long time and want to pursue something else. It's certainly also one of the more mature categories in crypto. So yeah, I think those are just some of the key reasons why we're really more seeing M&A activity and sell appetite really from founders in this space.
Yeah, what do you think actually about the issue that validation becomes more and more a commodity? Because at the end of the day, running a validator, if we leave out Zoe and Solana, it's not rocket science, right? And a lot of validators, like the ones from Finoa, Chorus One, Figment, Killen, a lot of the sophisticated investors, they prefer just staking 10% with them because they know, okay, they won't fuck it up, just to put it like that. And the rest they don't really care about because anyone can essentially do the infra play, right?
Yeah, that's definitely something we're also hearing a lot. Staking as a service is becoming more commoditized, and so you have some of the larger players that obviously have very high market share, and especially when it comes to now more institutional demand for staking are in a great position because size also creates trust, right? And larger organizations sort of a proof of sort of a proven track record really helps, like winning large institutional clients, right? I think the commoditized aspect is also really true for smaller players, right? That don't really have an edge unless they are like sort of on some of the networks you mentioned, or have a super lean setup and can really survive on a standalone basis. I think we're going to see a lot more M&A really because of that reason. Undifferentiated players will have a tough time really surviving in the long run and substantially growing their businesses, right? So I think as a standalone business, it will become or will remain really relevant and potentially also sizable for the big players. But I think a lot of the smaller players will really get acquired for that particular reason. and can create a lot more value than also when getting acquired by someone who has, clear revenue and cost synergies, right? And can really unlock more value with the business in-house rather than on a standalone basis. And so I think, therefore, really the players that will win in this market, and that's probably what we've been seeing also over the last years, is the ones that are more sizable, have the right approach in winning institutional clients, and maybe a superior product or some kind of differentiation that really helps them grow their assets under delegation and win in this category.
Maybe this also moves the entire question into a different direction, whereas how sustainable is staking really? Like basically a bigger validator company. Because obviously when you're like an institutional grade validator, you also have a higher payroll. So you need at least 3 to 5 like high level engineers, and they all earn 6 figures. Then you need like qualified people for BD, for research, for marketing, a CEO, CFO, all of these things, and then it gets pretty costly very quickly. So yeah, what's like the issue here? And I believe there are also right now a lot of validators that try to make more money outside of the staking and basically just take it as a bonus on top, right? That's also a development that we see in the industry.
Yeah, for sure. I think on your first point, I mean, the good thing is staking is as such a pretty scalable business model, and also the revenues tend to be quite recurring, right? Especially when we talk about all types of delegations or stake, really, right? It can be recurring. It is scalable. Now it's still subject to token prices, right? And therefore, it really depends on the networks you support, right? And sort of how crypto as an industry will do. So it's like highly dependent on the overall market fluctuations, right? So I think that's one thing. Sorry, Ryan, we have your second question?
The second question was like other business models.
Yes, exactly. So that's a good point. That's definitely something we've been seeing, I think, ever since, really, especially for larger staking companies who've been also trying to grow via expanding into adjacent categories. I think especially when you struggle to grow more organically within staking, it makes sense to expand. There's a few categories. I mean, obviously RPC nodes. Some have been also experimenting with software development in crypto, right? So adjacent services, really. Venture, I mean, it's not business model per se, obviously, because it's a lot of prop capital in that case, and research, obviously, but it's also more of a, integral part of a staking provider nowadays. But there are some categories that those companies, especially on the infrastructure side, have been trying to get into, and some have been doing this very successfully, right? There are clear synergies also, for example, with custody, right? I mean, Finoa has done a great job there, originally as a custody player, expanding into staking. And so I think there are a lot of good examples of adjacent categories where you can clearly own more of the value chain and create additional value for customers while also saving costs by not relying on external service providers or so. And I think this trend will definitely continue in both directions, and will obviously then potentially also drive some of the M&A activity.
Speaking of M&A activity, what's like the multiplier that you see the most in the validator business? Are we talking about 2 times, 1.5, 5 times, 20 times, 10 times, or does it strongly depend on the case?
Yeah, it depends on a lot of factors, actually. So I would say, first of all, in M&A, you would typically, as you say, look at the revenue multiples, right, as well as EBITDA profit multiples in order to value a business. And then you would look at private transaction comps, so previous M&A deals and how those were priced, as well as publicly listed companies. Now in staking, first of all, there are no publicly listed pure staking companies today. Yet, exactly. There are a bunch of private transactions, M&A deals that have been announced in the past, oftentimes with undisclosed deal value and undisclosed revenue or financials. So it's like pretty difficult based on public information to get a sense of how those are priced. You have some public comps in adjacent categories like Bitcoin mining. There are a bunch of publicly listed Bitcoin miners, obviously exchanges like Coinbase. Also, TradFi asset managers have some similar characteristics, so you can also use those as a comp. But to answer your questions, overall, what we've been seeing is anywhere between low to mid single-digit revenue multiples, and then it depends, again, a lot on the individual characteristics of the staking provider, such as the overall size, assets under delegation, the financial profile, profitability, margins, the supported networks, sort of the team expertise, the infrastructure, security setup. So really a broad range of factors that then sort of drive the valuation. But this is high level the range we've been looking at. And then obviously also depends a lot on sort of overall growth of the business, how they've been performing over the years in terms of winning new clients and also diversifying their customer base, not relying on one single network or one single client, right? But really, especially in M&A, there's always this risk of churn, essentially, right? Especially true for staking providers. So acquirers want to make sure that, this is a company that can really win more stake over time, and after the acquisition, there's going to be little to no churn ideally, so that I can actually get most value out of that acquisition.
Yeah, full disclosure, as mentioned also in the intro, we joined forces with Strike, which means that Friends was like one of the validators that was kind of ahead of the bell curve and entered an M&A process and got acquired by Strike. And but what I also find interesting when I talk to a lot of colleagues, and I think that's also what you just mentioned, it's like very hard to foresee a future in the staking business if you are not one of the big 5, big 7, big 10 validators, because from one day to another, a foundation can take away your delegation, and then all of a sudden we are talking about a completely different valuation if your biggest client, so to say, jumps off. And the sets are also getting smaller. So how do buyers price this uncertainty with like a super low revenue multiplier, or will it actually get worse over the next couple of months? What do you think?
Yeah, so in an M&A process, buyers do like a lot of due diligence, as you know from your process, right, on like all types of factors to essentially mitigate any of those risks, right, and form a view and prices in ultimately also on the deal, right, especially for the delegations, the clients. There will be a lot of analysis and sort of understanding really the client base, how sticky everything is, right, in order to really put a bid forward. And if there are certain networks where churn is more likely, Lido is always a big topic for larger validators, right? So this is usually priced in. If a larger staking provider who is a Lido operator is looking to acquire a smaller one that is also a Lido operator, then essentially you would already price in that the Lido stake would disappear, right? So a lot of these elements, some of them can be anticipated, others are a bit more tricky. And so obviously as an acquirer, you need to find the right balance between, mitigating risk by also ideally acquiring a business at a lower multiple, but at the same time being competitive, right? I would say nowadays these processes, especially for larger players, have become more competitive because staking, while it has some difficulties on a standalone basis, as we discussed, right, there's just such strong synergies with a lot of acquirers outside of staking and potentially over in the long run also outside of crypto. So I think on a more positive note, this might also drive valuation in the long run, especially as TradFi asset managers and banks and so forth are starting to acquire staking providers. And so in order to be competitive, really, valuations might also increase, and you just have to deal with some of these potential risks as churn, for example.
Yeah, two follow-up questions on that. So first off, it seems like that the multipliers like 2 or 3 years ago were much higher. So 1 to 2x of the revenue wasn't the case when especially the large validators were valued. And so that's my first question. The other question consequently is, does that also mean that there's more on the seller side than on the buyer side? How many people are there that actually want to buy a validator?
Yeah, good question. So on the first one, I would say this is true not only for staking, but for crypto and probably tech in general, right? The valuations we've been seeing, especially around 2021 in tech,
Except
in
AI.
crypto, except AI nowadays. But the multiples also for all these crazy fundraising rounds in 2021 have come down significantly, right? So a lot of businesses in the last 1 or 2 years have been struggling to raise at similar multiples or even close to it, right? Or selling their businesses at those multiples. So I would say it's a general market trend, right? Multiples have just come down, right? For staking and crypto more generally. Then secondly, it's probably also to some extent attributable to just the industry struggling with certain aspects, right? So again, the topics we discussed, right? The service becoming more commoditized. It's becoming increasingly difficult to operate at high margins, right? Because fees are coming down significantly. And so therefore, overall, the quality of the business or the category is potentially not as high as like people would have anticipated a few years ago when staking as a service was still a relatively new category. So yeah, I think this explains quite a lot the decline in like revenue multiples and overall valuations for staking businesses. Now, to your second question, I would say it can be also partly explained, yes, by more companies being on the sell side than on the buy side, especially true for, I think, the long tail of staking providers. So think of smaller companies that are barely break even in this market, maybe have been profitable in 2021 or pretty profitable, but are now struggling with all these new developments in staking. So therefore, I think on the long tail, there is more appetite for really selling validator business, and especially for smaller companies, it's more difficult to find an acquirer because obviously, M&A is always a bit of an effort, right, on both sides to get a deal done, to integrate the business, and so there needs to be certain minimum size in order to be worthwhile also for an acquirer to do a deal. I would say when it comes to larger companies in staking, the multiples tend to be a little bit higher and those deals can be more significant, and there's also more appetite than, again, especially outside of native staking providers, really from other categories as well, which ultimately can lead to higher valuations. So yes, I would say for especially the upper end, there's more buy-side appetite than for the lower end, and ultimately on the sell side, there's also more interest from smaller players really to get acquired than larger players today.
And what's your personal projection there for the future? So does this basically mean that all of the smaller validators basically have to compete each other, who's getting bought first by one of the big fishes, and is it like basically race to the bottom? Like basically who would let go of their validator for a lower price? And how many requests do you basically get to lead such a transaction?
Yeah, good question. I think on the first one, it's difficult to forecast also because it's really highly dependent on the crypto markets overall and token prices, right? So I don't love to make projections about that, right? But that can obviously drive a lot of this answer here, right? In terms of profitability of smaller providers, right? And also as to which networks really do well and consequently which providers are well positioned there to capture some of the growth potentially, right? I would say that probably there's gonna be more activity and also on the longer tail, right? And I think this will be mostly driven within the categories. So I think we'll see a lot more horizontal M&A where larger staking providers acquire those smaller validators on certain chains that are interesting for them. Maybe also to expand geographically, right? Think of a American staking provider trying to build out a team in Asia, right? And thereby acquiring a local smaller provider. I think that's one. Then I think there's also going to be just an increase in vertical M&A across the value chain, basically what I mentioned earlier, right? Where I think this will drive a lot of the M&A activity, especially for the larger players. And then probably over time, we'll also see more of the frontier M&A, what I would say, in staking. So think of restaking, liquid staking protocols, acquiring competitors on other chains, really, right? Things like that. So I think besides the more traditional staking as a service provider, it's probably also something where we're going to see more activity in the future. And then to your last question, in terms of the amount of requests we're getting, I think definitely a lot more over the last half a year. Obviously, can't say the exact numbers, but we've been having some interesting conversations. There is definitely appetite, but vice versa, also interest on the buy side, right? I think we've been hearing from a lot more companies over the last half a year that they're looking at staking providers and want to acquire this. Maybe are still forming a final view on whether acquiring versus building this in-house makes most sense, but it's definitely also more buy-side interest. I think just because there have been so many announcements and a lot of companies are coming to a realization, okay, this makes sense to bring it in-house and it's highly synergistic with what we're doing. And so
cheap at the moment, relatively cheap.
Yeah, I mean, it depends also what you compare it against, right?
2021 bull times.
That's for sure, yeah. And it's probably also true for a lot of other categories in crypto. If we look at Coinbase multiples over time, it's always for us a very good benchmark because it's obviously a prime player in the industry, publicly listed. Those have also come down from low to mid teens end of last year to 7 times revenues, I think, now. So also, again, shows that sort of overall multiples have come down. And again, as you say, this also drives M&A activity, then also for staking for sure.
Yeah, like I think how also, because I talked to some folks, and the overall sentiment was also that in the foreground, it's not only about acquiring a validator to have it in-house, but also like the team, because finding talented engineers where okay, they're able to do it, they're able to get the job done, isn't that easy. So you can basically say, hey, there are like a couple of validators, they are profitable, we buy it for like an X revenue share, and in the same move, you also acquire like a talented team. So it's also like kind of this, it also has like a taste of a hiring player, right?
For sure, especially for the smaller deals, right? Where you just want this talent, maybe even in a specific, jurisdiction where you're not present yet and looking to build out your team anyways. Maybe you get some people that, have certain skills that you really want on the team in MEV or other sort of topics, right? So there's always also this talent acquisition aspect to it, especially for smaller ones, but also for bigger teams that have, really highly specialized skills internally.
Yeah, I think we see this more and more and more. But yeah, also like interesting to see that there's like more, that there's more M&A activity all across crypto. So I guess there's a lot on your plate right now, right?
Yeah, exciting times and also very busy times for us. Yeah. No, it's exactly what we basically anticipated when we started the business 3 years ago, right? I mean, crypto as an industry is maturing. It's in certain categories highly fragmented, like in staking. And obviously, as we also develop finally some use cases and more real-world traction, there's going to be more appetite outside of crypto, really, right? And so I think those are all trends that, we're now seeing the very first innings of like, M&A activity picking up. And like in any other new tech sector, this will only accelerate over the next decades as the industry matures. And yeah, hopefully it's going to keep us very busy going forward.
Last question, because we, once again, about the multipliers, do you think it's also a net bullish sign for crypto that nature is healing, kind of a thing, that we are getting more down to earth, that we are getting a little bit more mature, that we not blindly use a 20x multiplier on a validator that barely makes any revenue because soon it will generate a lot of revenue, or that we as an industry look more on the real revenue side of things. So you think that's actually a net bullish sign for crypto, because all of these deals also make more sense to me now, seeing these multipliers in a 1.5x to a 3x area?
Yeah, 100%. I think in general, just the fact that we're as an industry focusing more on revenues, profitability, it's a good development, right? Because, essentially those are businesses, right, that, need to generate fees in order to be sustainable in the long run, right? And then obviously you have nuances, you have like all types of different protocols and businesses in crypto that may have different purposes and monetize in different ways, right? But overall, I think just the fact that more attention is really on revenues and financials, right, is good, because it also really allows us to be taken probably more seriously in the long run from non-crypto native companies, right, especially in an M&A context where, obviously there's a lot of similarities to fintech or, traditional finance companies, banks, asset managers. Obviously, highly depends on what business model you look at, but ultimately, crypto will also be benchmarked against those in the long run, right? And so if multiples are way off, then it's going to be much more difficult to get deals done there, right? And so I think the recent developments in terms of, financials being more important, revenues, and then also those bigger M&A deals that we briefly talked about, right, in crypto that really speak for some early signs of product market fit of the industry, or and also really of the industry being taken more seriously and maturing as a category for people who are not in our industry.
JP, thank you so much for coming on. It was a pleasure.
Likewise. Thanks a lot for having me, Yuri.